How are you managing your investment portfolio right now amidst all the market volatility? Hey everyone, it's John Chapman, certified financial planner with WorthPoint, with a few charts and graphs to share some perspective to help you ultimately stay on track and hopefully reach your financial goals. No doubt we've had a very challenging year since January. The market has dropped around 20% as of June 2022. And what I wanted to look at is the past market cycles when we've had a recession or a bear market and the market has dropped. What have been the market dynamics over that time so that we at least get some context for what might happen in our market environment right now? And looking at a blog post published by Nick Maggiulli on his Of Dollars and Data blog, we can see major bear markets of the past, like the 1929 Great Depression, the 1973 years of high inflation, the 2000 tech bubble, and the 2007 housing crisis. In each of these cases, as the market ultimately went down, it did so in sputters and spurts, where it went down, it went back up, then it went down a little bit more, and it went back up. Now, we don't look at this as a way to try to guess when the market's going to turn around, and we don't look at this trying to think, oh, I'm going to get out and get back in, because that's all a fool's errand. But what's important to take note as long-term investors is you really have to be patient in order to stick with your game plan, and that there's bound to be times when the market is swerving up and down. But there should continue to be confidence for long-term investors because as this chart shows, when you zoom out over a long period of time, the stock market has delivered significant compound growth. And the vertical lines show times when the market has dropped by either 10% or 20%. And as you can see, it's somewhat frequently that the market does experience volatility, and yet there's such innovation and such disruption that the stock market has persisted over time. And while we don't know exactly what the next 100 years might look like, long-term investors still have the odds in their favor, taking risk and investing broadly diversified and capturing the returns of public companies in order for them to grow their money over time. So with that as a backdrop, let's put some clarity and structure around things you can be doing right now. And at a high level, a financial plan consists of 5 parts. It's first looking at your financial goals, then matching those goals to an investment strategy, then protecting yourself through insurance and estate planning, and finally helping you keep more of what you earn through appropriate tax planning. And right now, let's just focus on goals and investment strategy. It's first important to ask yourself, what are my goals and what's my time horizon? And let's just use a case study during our conversation now of a 55-year-old that has maybe 8 to 10 years left during their work time horizon. So their goal is get to retirement comfortably, and their time horizon is maybe 8 to 10 years. Well, the next step in this process is finding a profile of stocks and bonds that matches your time horizon and helps you stay diversified. One of the challenges and risks that I see as a financial planner is folks that are too heavy in one direction. Maybe they've picked a lot of individual stocks. They get stock options or RSUs from their company, and they're really risky in that regard. Or maybe they're really scared of the market, and so they've got a considerable amount of money in cash. It's all about finding a balance so that you can get the biggest return for taking the least amount of risk. And once you do that, the final thing to implement is a bucket strategy. And this is a helpful visual to know that the way that you're going to spend money at the time of retirement falls into different categories. So if you could set up an emergency fund that has 6 months to a year in cash savings, followed by a medium-term bucket that has your next 1 to 4 years of retirement spending in low-risk assets, that takes some of the stress off of bucket 3, your long-term assets that are growing and at the whims of the market. It takes a little bit of pressure off of knowing that you have time for your growth assets to recover while your medium-term assets provide some safety and security. So with that, I encourage you to stick to your plan and stay on track. Don't get distracted by the zig and zag of the markets now, but instead focus on what you can control within your financial plan so that you can have financial independence in the future.